Good afternoon, everybody, or good morning, depending on what side of the country you are on. So, as you all know, I went to San Diego and I saw my man Amar out there. And Amar lives in San Diego, and they haven't kicked him out yet. They're thinking about it, but had a blast. We went to University Heights. Is that where you live, Amar? Is that what's called?
Yeah,
University Heights.
just north of Balboa Park.
Say again.
I live just north of Balboa Park.
Just north of Balboa Park, so you guys know where to avoid, okay? But we said, man, we got to start doing these things on a regular basis again. We did it a couple of years ago. We just got out of it. And so every 2 weeks, Amar will be joining us live. So we're going to do financial industry trends, because Amar has got his ear to the ground on that. And then we're going to do case studies kind of thing. We're just talking about strategies and whatnot. So, and these will be short, 20 to 30 minutes each. There won't be 2 hours or anything like that, but it'll be fun, and it's just good to revisit back with Amar. So welcome back, Amar. Welcome back to Heritage Wealth Planning.
There you go, Josh. Thanks for having me. Yeah, it's been a while since we did these. I mean, I think before the pandemic, we were trying to do these YouTube live things, and then we got away from it. But I think it's good that we're getting back to it. I think there's some key tax planning opportunities in this year as well as next year before the Tax Cuts and Jobs Acts sunset. Potentially those are going to sunset. And so, let's just get into it.
Want me to bring up the slides?
Yeah, sure.
Gotcha. Right on. So can you see that, Amar, what I'm looking at?
I can see it.
Gotcha. All right. So you want me to click on the disclosure thing first, or there we go?
Yeah. I believe I can navigate this as well. So
okay. Oh, you can? Sweet.
Yeah.
Thanks.
So, just, one thing that's different between Josh and I is, I manage funds, for clients. And so we're registered and, regulated by different folks. And so, we're not entering into a client agreement. This is, strictly for educational purposes.
Exactly.
Josh, you want to give you a little disclosure as well?
Yeah, so this in no way is a solicitation for Amar. I just want to be very clear there. We're not saying, oh my goodness, Amar is the best thing since sliced bread. So we're just anytime we're doing it with a guy like Amar who actually manages money, you got to tell people like, look, this is not a solicitation. It's for educational awareness only.
I would say I'm the best thing since sliced bread, though. That's very accurate. No, just kidding. Just kidding. That was a joke.
You did your team did go 2-0 on Saturday, so I guess you're Coach K.
Yeah. And for those that don't know that, I was coaching my daughter's basketball game, and so we were doing full court, high speed. So today we're going to compare kind of 2023 tax rates to 2024, and what we could be thinking about in terms of planning for the Tax Cuts and Jobs Acts to end in 2026. So the first slide that you see up here essentially just shows the difference between 2023, which, God, I guess it's the closest one to where our pictures are at, where it's for a married filing jointly couple, it's 22,000 to 89,000. It's a 12% rate. And then that rate in 2024 jumps up to 23,000 to 94,000, right? So and we're not going to go over every single number because you can just Google that and look it up. But I think the key thing to take away here is those brackets are getting bigger. So because of inflation, those brackets are getting bigger. So in 2024, if you did get an inflation increase in terms of pay, you're not going to be paying more taxes because the brackets have gotten wider. If you didn't, you may be paying less taxes, right? So there's a couple things going there. But I think the key thing to look at when we look at this is in 2026, these tax brackets are going to have two major changes. And so what I did is I put up a slide and these numbers are old, don't look at these numbers, but what I want you to see is if you look at the left-hand column here, can you see my mouse? I don't know is that visible?
I can't see your, do it again.
Okay,
no, I don't see your mouse. Yeah.
Okay, so I just
want to go back.
To a different slide. Yeah, there we go.
Oh, okay, there you go. I'll let you do it. Go ahead.
All right. So basically, prior to the Tax Cuts and Jobs Act, we had tax percentages for these gaps to be between, we had the same number of tax brackets, but we had a higher tax percentage. So if you see the 12% bracket today was the 15% bracket. The 22 was the 25, 24 was the 28, 32 was the 33, 35 to 35, and then 37 to 39, right? So the rate that you were paying was higher before the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act is going to sunset at the end of 2025. So 2026, January 1st, if Congress doesn't do anything, we're going back to these old rates. Okay. And these brackets, and this is the second thing that I want to highlight, these brackets, if you compare the brackets for the same rate, so the 2022 to the 2025, but just comparing the room within each bracket, those brackets are going down. So they're shrinking. So another way to state this is the current brackets have more room in each bracket. In 2026, you'll have less room and you'll have a higher rate.
Yep.
Right. So it's very important for the next 2 calendar years, so 2024 and 2025, to be proactive with your tax planning, because if nothing happens, you're going to be paying a higher tax marginal rate, and more dollars will be taxed at the higher rates because the brackets get narrower.
And you got less standard deductions too. That's a lot of people miss that out. So the brackets get narrow, the rates go higher, and you have less standard deduction.
Yeah. So I think as you're looking at planning, one of the opportunities is and there are many opportunities. We're just giving examples, right? So one opportunity is Roth conversions, right? So if you're, have a large IRA balance, you could potentially convert some of those dollars, maybe to the top of these tax brackets here, pay some of those taxes now. So in the future, that money is tax-free. There's no RMDs on those money. It goes to your spouse, tax-free, goes to your children, tax-free. And so you can really kind of maximize the current brackets that you're in today.
Absolutely. Yep.
So when we look at this,
there's standard deduction right there, right on.
The second thing is the standard deduction, right? So what happened in the Tax Cut and Jobs Act is that they essentially doubled the standard deduction and they got rid of the personal exemption.
Yep.
That is going to sunset and go back, and nobody knows what it's going to be, but I just wanted to highlight that, for most people, especially in retirement, itemized deductions may not get close to the standard deduction. And another way of saying the same thing is that I bet a majority of people pay standard deductions now. In 2026, that can change, right? So here, from a planning perspective, if you're charitably inclined, you may want to take the standard deductions now, and then maybe fund a donor advised fund or some other vehicle that you can use to gain more itemized deductions.
The vast majority take the standard. I think it's like 93% take the standard deduction, only like 7% itemized. It's crazy.
Yeah, it is crazy.
So a lot of people actually do tax planning thinking they're going to get a deduction on this, that, and the other, and they just don't. So that's where the tax planning comes in. You could say, hey, I'm not going to give a charitable donation this year. I'm going to put them twice in next year so I can double up my charitable contributions, which puts me in an itemization as opposed to a standard deduction. It's just some basic stuff that I think a lot of people overlook for sure.
Yeah, and especially with the donor advised fund, you're putting contributions in there, so you really don't want to put cash in there, but you could put a stock that's gone up in value, so you eliminate the capital gains portion of that, and you get the deduction all in that calendar year, so you can itemize that year and then go back to standard deductions in the following years. But it doesn't mean you have to give all that money to charity that calendar year. You can spread out.
Amar, we should do a video solely on donor advised funds. Actually, that'd be a good concept to have specifically, because that is a good tool for sure.
Sure. And then one thing maybe just to highlight, the the capital gains tax, right? So before the Tax Cuts and Jobs Act, the capital gains was tied to your income bracket. Like, so if you're in the 10 to 15% bracket, you paid 0 capital gains. If you were in the all the other brackets up till the max, you paid 15%, and then you paid 20%. That changed with the Tax Cuts and Jobs Act, and now there's 3 separate brackets for those capital gains pieces. Those numbers may also change, right? So there are a lot of variables if Congress does not act. I see in the comments here that Fast Eddie.
He's a pool shark.
Yeah, this is this is exactly right. This is if Congress does nothing, right? Yeah. And it's probably important to highlight that we have a government debt that's at 34 trillion, right? And the deficit is growing. And so the government needs to raise income, that's through taxes, and needs to cut spending. It needs to do both, right? So these things that we're talking about is in the likelihood that tax rates go up, right? Your personal situation may be different. You may be moving from, I don't know, a high tax state to a low tax state. You have to take your personal situation into consideration here. But the next thing I want to talk about is AMT.
AMT.
Oh, man. So this
is a big one right here. This is big.
The top 3 things that we've talked about have all been around income, right? And AMT is the same. The biggest thing that I can say around AMT is that we
explain what AMT is, just so people know, Amar.
Yeah, so AMT is alternative minimum tax, and in 2017, the AMT provisions that impacted AMT were greatly reduced or repealed or scaled back. Yeah. So before, I would say in 2017 and prior, there were about 5 million people that were impacted by AMT.
I got hit with AMT in 2017. Friggin' pissed me off, man.
In 2018, that number dropped from 5 million to about 200,000 taxpayers that were impacted by AMT. And that's kind of referenced in this graph on the right, where a lot of people stopped paying AMT. But that's going to sunset in 2025 or 2026, and that number is due to increase. And I think the significance is huge. And I put another table here. I'm trying to click to the next one here. So this is a basic calculation, and we've referenced where we pulled all these slides from back at the end of this deck that we can share with anybody that would like. But say you take a couple making 310,000 combined. Before the tax cuts, their tax liability was 59,000. Then you add in all the itemized deductions because we're doing an AMT calculation, and their tax liability was 61,000. Then came the Tax Cuts and Jobs Act, and based off of that, we limit their state and local taxes to 10,000, and they have the itemized deduction. So their tax liability essentially was 55,000, and prior to that, it was 61,000. Well, that's the change that's going to happen. Not I'm talking about the direction, not the actual dollar amount. Meaning that when the Tax Cuts and Jobs Act sunset in 2026, those preferential items are going to disappear, and you'll go back to AMT. Yeah. And so the biggest group of people that I think this will impact is people that have incentive stock options. So if you have incentive stock options, there's an amazing time to do some planning, because that fair market value minus that exercise price is going to be added back into your AMT calculation. So definitely some tax planning for those folks.
So just real quick, Amar, on that graph, what does it say? Millions of taxpayers, what does that say? 2026 be like 9 million? Is that what it says on that graph?
Yeah, I mean, this is from the Tax Policy Center. I don't know the exact dollar amount, but I think, it's going to be more than what's today by a significant threshold.
Yes, I mean, it's crazy when you think about how many people got sucked into AMT. And remember, initially, A lot of the tax brackets used to not be subject to inflation in the 70s. So you had bracket creep. And that's the same thing with Social Security taxes and net investment income tax and AMT, where all these things bracket creep where they weren't subject to inflation. So if they go back to pre-Trump, it's gonna be bracket creep again, where more and more people are sucked into AMT. It's freaking despicable, man. That's just it's really just evil, man. No other way around it.
Yeah, so and we should probably make the clarification that we're not CPAs, we're not tax professionals. Talk to a qualified.
We're just cavemen. We're just cavemen. We don't know anything.
Yeah, I'm Mr. Disclosure too with all this, but the AMT tax calculation is separate from your ordinary tax calculation, and so you're doing both of these tax calculations at the same time, and you have to pay the greater of the two, right? So a lot of miscellaneous itemized deductions that were previously disallowed or previously allowed in the adding back to your AMT calculation were disallowed, and now they're coming back. So that's, like if you have tax exempt bonds, if you have interest expense, all those things are coming back. And again, if you have stock options as part of your compensation, this will be a big part of that coming back to be included in your AMT calculation. All right, so we talked about income, right? So the next thing I kind of want to go over is retirement plans, right? So again, at least on my left, or closer to where Josh and I are, is 2023. On the opposite side is 2024. And the big thing here, that a couple of things that we should kind of look at is, the contribution limits are going up, right? So if you don't have automatic increases in your retirement plan, you need to go in there to increase your contributions to the max if you're doing that. The other thing that I often see is most retirement plans will have a pre-tax bucket, a Roth bucket, and an after-tax bucket. And if you go in and you haven't touched your annual contributions, you're probably only funding the pre-tax bucket. And that's typically to get the match, right? Every year, there's a maximum limit per participant that you can contribute to a defined contribution plan. So in 2024, that dollar amount is $69,000. So just taking out my handy calculator here. So if you take $69,000 minus, let's say you're putting the max contribution of $23,000, and let's say you get a $6,000 match, there's $40,000 that you could be adding to the after-tax bucket. And if your plan provides an ability to convert it to a Roth, you fund it and you convert it to a Roth in the same tax year, and you get what's, I guess, industry known as like the mega Roth, right? So there is a planning opportunity there for those that have that in their retirement plan as an option. If you're a professional, like doctor, dentist, or lawyer or whatnot, and you have a defined benefit plan, which is kind of like a pension, that contribution has gone up, but the total contribution has stayed the same at $3 million. So every year you can put up to this dollar amount in. There's a calculation of how much your plan's present liabilities versus how much is actually in the account, and you have a dollar amount that you can fund. But that'll impact professionals that are also business owners. Simple IRAs. Now this is where it gets interesting, because in between the Tax Cut and Jobs Act, there was also the Secure Act 2.0. Mm-hmm. And what this did, and I have it written down here on another screen, but you will notice that under the simple IRA, the max is $16,000, but in parentheses it says $17,600 for a 10% increase. Well, essentially that means if you have a small business that has less than 25,000 employees, or less than 25 employees, and you're contributing, they have compensation of at least $5,000, you can actually put more than the $16,000 amount. And if you have more than 25 employees but less than 100, and you make a match, you can also qualify for this. So really interesting stuff for small business owners.
Yeah, absolutely.
Um, for individuals that have a small business that is just them and they probably just have a SEP IRA or a solo 401k, remember, you take your total business profits, let's just say that's 50,000. You subtract for the self-employment tax, which is 15.3%, and then you get your adjusted net business earnings. That number times 25% is the maximum you can contribute. So if you have other employees, you have to contribute the same percentage, but let's just say this is a one employee business. That's 25% of that dollar amount. If you are in that position, there may be some trade-offs between that and a solo 401k, right? So those are some things to kind of look at in the retirement planning space. Anything to add here, Josh?
No, and those aren't just, that's not going to affect the Trump tax bill, right? So these are just progressively going up with inflation. But there is, the inflation numbers did make these numbers grow quite a bit in terms of what you can defer and things of that nature. So it's always something to consider for sure. Again, just kind of going back to, if let's say you're a commission person, maybe this is a big year for you, and next year might not be. There's a changing tax scenarios for depending on your situation that you should be aware of. Like Marie says, she has got her taxes back. With ACA, Affordable Care Act, is complicated to do on my own. And I'm just, these taxes are going to get more and more complicated for sure with all the, the various Trump tax bills and all that stuff going away. So just, don't minimize your understanding of taxes just because it's kind of dry. Know them because this is your money. Come on.
Yeah. So the next thing is estate planning.
Bob wants to say hello. There's Pablo.
So estate planning, man, this has been all over the map. And we'll link to an attorney's website that we found that, just put what the estate tax exemption has been over a period of time. In let's say 2000, the estate tax exemption amount was 675,000.
Yep.
And it's gone from there all the way up to, in 2010, there was no estate tax. You had a choice. You can either pay the estate tax or get a step up in cost basis, right? Like you had a choice at that point. And then it switched over to 5 million. So we went from 600,000 to 5 million. Then we went from 5 million to 11,180,000. And today that number is at 13,610,000. So essentially saying, it essentially says that we each have 13 million as a lifetime exemption. So if you're married, combined, that's 26 million. So this doesn't really impact a ton of people, right? But this number is going to be coming down, right?
Yep.
And again, this is if Congress does nothing, right? So Charles Schwab has this has a graph that's here on the right, and so really people will fall into three camps, right? If you have, and let's just say this is roughly, just to make math simple, I'm just going to use 6 million, right? So if you have a total of 12 million or more, if you're married filing jointly, you have to look strongly at some complex estate planning strategies to gift out of your estate the amount that's above, right? And that's to avoid taxes. So there's a spousal lifetime annuity trust. There's all these things that you can do to use up some of that exemption amount, because if you don't use it, it could be potentially gone, right? If your overall net worth is between 6 to 12 million, you have to start using some of the gifting strategies to make sure that your overall estate doesn't go above this exemption amount in the future. And then if you're below, you got to start making sure that your estate doesn't continue to grow, right? And that's one of the things that you do by either spending more or gifting to your children or charities and so forth. So You don't have to give, right? Some people, everyone's situation is different. You know, and these estate exemption amounts kind of come in and go out. It's like a pendulum, right? It depends who's in power and so on and so forth. And so here, the idea is to maximize or to reduce the potential tax burdens that may happen in the future, right? So,
and don't forget, there's some states, I think 13 states have some sort of state estate or an inheritance tax. So just remember that too. So,
yeah,
and those are a lot less beneficial than the federal one. That's for sure.
The federal one is, this is only on from the federal estate tax. Yeah. So from a planning perspective, there is some opportunities between these. So, I guess, Josh, if you want to take the slides down, the next slide is just the references. So if anybody would like those, we can hand those out. So,
well, not hand them out, Amar. You're going to go to people's house and hand them out.
Well, we'll digitally handle them out. So I think so. This is a good maybe opportunity to do a shameless plug. I have a YouTube channel as well called Client First Capital Learning. You can follow me. We also have a website. We do a newsletter. Please, subscribe to both our YouTube channel as well as our newsletter if you find this information helpful. And if you have any questions or concerns and you just want to chat about like your situation, I'm more than happy to spend some time to kind of.
And Amar sends out, you do your blog, you post on the blog a lot more than I do, but at least a couple times a month, right, Amar?
Yeah, we do one newsletter at the beginning of the month, but it has several blog articles in there.
Okay, right on. Yeah. So Amar actually if you subscribe to Amar's email list, you'll get like Chris Barfield does his monthly-ish newsletter. Amar does the same thing. And Pulverizer said he's a subscriber to your YouTube channel. Yeah. So I'm sorry, Amar. I'm sorry about that. And I just want to point out too, it's like the estate tax. We have both the estate tax and AMT. And I've been, it's one of those things kind of out of sight, out of mind because we haven't had to worry about it. But it could come back strong, and if it could come back pretty voice, I don't know whatever that word is, forcefully, I suppose. And if so, man, if you don't want to be caught with your pants down, you need to have you do anything, but you should be at least thinking about how these could affect you. And Marie asked about what wage earners are affected by AMT. So Marie, back when we were affected in 2017, it was me, my wife, and 4 kids. So I had 4 tax deductions on my kids, and we still owe extra $12,000 of AMT. And I made like $230,000 or something like that. I can't remember what it was, but you had to fill out 2 tax forms, like Amar said, the 1040 and the AMT, and you got to pay which is greater. And that's 2017. I wasn't a millionaire. I still had 4 little crumb crunchers, and we still got hit with it. It's nuts, man. So higher wage earners will be affected by that for sure.
Yeah, and I think our next video we planned 2 weeks out is actually a case study. So stay tuned for that.
Amar Pulverizer says you never insult your subscribers. Man, you got to be insulting them, man. Like look at Tom, man. Here is Tom. Tom's like, I've been using H&R Block for years. Wow, Tom. Wow. Oh my goodness. And it's so easy. Tom can use it if you know what I'm saying. But yeah, so every 2 weeks at noon, is that what we decided? Noon Eastern time. Yeah. Remember, Amar's in San Diego, so he's got to get, because Amar likes to surf, and he's got to get off the beach because he's on the beach, smoking and joking. But every other Wednesday at noon Eastern, we'll be doing various topics with Amar. Again, industry trends. We'll probably talk about index annuities at one point because I on at least of my LinkedIn feed, that's getting a lot of traction lately, which we need to talk about. All kinds of stuff, and then we'll do case studies as well. So Tom says he's used to the abuse. Right on, man. Right on. All right, Amar.
All right, Josh. Thank you, everybody.
Guys, and for Locals channel, we'll see you guys at 8:00 tonight on Locals. I gotta get these. All right. Oh my. Who wants a dog? Anyone? Anyone want a dog? Amar, you want a dog? All right. See you guys. So I'm gonna take care of these knuckleheads, and we'll see you guys on Locals at 8. Look at this guy. Neighbors love that. Yeah. Oh my. Look at this guy. Oh boy. They're like, oh, it's nice to hear regional advice from Amar. You don't like this regional advice? What is wrong with you, child? Oh my goodness. All right, so I appreciate y'all being, man, look at that beard. Dude. Oh my goodness. Look at that beard. All right, see you guys. God bless. See you tonight on Locals. Stop. Controlled by hounds. Exactly.